What happens when a foreign government changes the laws of trade overnight? Turning to the shipping lanes, a massive regulatory shift is taking place right now across the Indonesian archipelago. The legal architecture governing regional trade is being completely rewritten, and it directly impacts the cash flow of every Singapore investor holding stocks dependent on those trade routes. I have been digging into the data on this policy shift for the past few days, and I had to run the numbers twice because the scale of this capital chokehold is staggering. If your retirement portfolio has exposure to regional resources, you cannot afford to look away from what is happening in Jakarta. I want to be upfront about something. I am not here to push stocks or manufacture excitement about the next big name. I am here for the Singaporean who is 5 years from retirement or already in it, the one who cannot afford to chase a yield that collapses when the balance sheet cracks. A single breaking news update last week completely upended decades of stable regional supply agreements. Indonesia has abruptly stripped private entities of their export autonomy and handed central control of every single palm oil, thermal coal, and ferroalloy shipment to a newly established state apparatus. For any retail investor holding a local portfolio, your primary concern shouldn't be global price fluctuations. The real question you must ask is what happens to the immediate transaction velocity and cash flow visibility of your holdings when their core supply lines are altered overnight. On the 20th of May 2026, Indonesian President Prabowo Subianto pushed through a monumental policy shift that directly alters regional resource trade. He moved full operational control of all palm oil, thermal coal, and ferroalloy exports away from private corporate hands and directly into a single state company called PT Danantara Sumberdaya Indonesia. Private exporters are now legally banned from selling directly to international buyers. The Indonesian state has placed its own regulatory machinery squarely in the middle of every single commodity contract and every export transaction. Jakarta's justification for centralizing this trade network boils down to preventing massive long-term revenue losses. President Prabowo stated explicitly to Parliament that over the past 34 years, Indonesia has lost up to $908 billion in potential revenue due to underpriced resource exports. The domestic markets reacted with immediate panic to the policy announcement. The Jakarta Composite Index suffered a sharp two-day drop. The Indonesian rupiah fell to a record low per US dollar, and Bank Indonesia enacted an emergency 50 basis point rate hike to push its benchmark to 5.25%. Most institutional analysts sitting in corporate offices are viewing this as a standard instance of localized resource nationalism. They assume that the friction stops at the Indonesian border. But a forensic look at the numbers tells a completely different story. Retirement-grade investing is not about following daily hype or looking for exciting stock market breakouts. It is about cold, disciplined tracking of cash flows and understanding exactly how structural roadblocks change the underlying risk profile of your retirement capital. This regulatory friction will show up at your kitchen table long before it appears in an official corporate annual report. For an average household in Bedok or Toa Payoh, the first sign of trouble won't be raw bulk commodity prices, it will be a steady rise in daily expenses. Singapore exports $39.83 billion worth of goods to Indonesia, acting as a massive regional refining and re-export hub. Any upstream bottleneck that delays cargo processing at our docks creates an inflationary undercurrent, keeping your daily cost of living higher for longer. This structural friction creates an immediate roadblock for your Central Provident Fund and Supplementary Retirement Scheme allocations, with Bank Indonesia pushing its benchmark rate to 5.25% to defend its currency. Borrowing costs across the region will remain elevated. Your CPF Special Account provides a completely safe, risk-free benchmark return of 4.0%. This means the threshold for taking equity risk has never been higher, and any Singapore exchange stock exposed to this cross-border disruption must clear my strict minimum hurdle rate of 4.7% to justify a spot in a retirement portfolio. The absolute linchpin of this entire policy shifts into place on the 1st of June 2026. Starting then, Indonesian exporters must bring 100% of their foreign currency revenue back into Indonesian state-owned banks. Cash that previously cleared through Singapore's commercial banking system to provide corporate liquidity will now be legally locked inside Jakarta's capital controls. This places an immediate threat over two distinct groups on the Singapore Exchange: agribusiness giants operating regional plantations and the commercial banking groups funding resource infrastructure. Looking directly at the Singapore Exchange counters caught in this regulatory grip, large-scale palm oil producers like Bumitama Agri and Golden Agri Resources are completely stripped of their free market export capabilities. Every single ton of crude palm oil they harvest in Sumatra or Kalimantan must be manually cleared by the Danantara state monopoly before it can legally leave port. Simultaneously, Singapore's major commercial banks face direct credit exposure to regional mining projects, creating a sudden loss of distribution visibility for local income investors. The real story here is not the global price of coal or palm oil, it is the structural choking of transaction velocity. When a foreign state sovereign wealth unit takes complete control over contract matching and export payment clearance, processing times become purely political decisions. For a local retail investor, knowing that global commodity demand remains high is completely useless if the delivery pipeline narrows. When the underlying cash generation cycle slows down, earnings visibility disappears. The market values certainty. Jakarta has just institutionalized friction. Now let us look directly at the hard data from the forensic ledger. The Jakarta Composite Index shows a negative 4.32% two-day drop, that is capital flight made visible. The Indonesian rupiah has plunged to a record low of 17,700 per US dollar, escalating corporate debt strain. Bank Indonesia's benchmark rate stands at an emergency peak of 5.25%, while 5-month nickel futures have spiked 30% due to supply quota restrictions. Most critically, the trapped revenue mandate leaps from 30% to 100%, completely freezing offshore cash retention. This 100% foreign revenue repatriation mandate is the absolute structural barrier, making broad macroeconomic commentary completely obsolete. For a 60-year-old retail investor in Jurong East managing an SRS account for reliable retirement income, this creates a major corporate cash block. If a listed company cannot freely move its foreign currency earnings out of Indonesian state banks, it faces an immediate hurdle in servicing its offshore debt or funding its Singapore dollar distributions. Retail investors are completely missing the second-order threat of the corporate treasury trap. No one is physically stopping palm oil or coal shipments because the Indonesian state desperately needs the transaction volume. The real danger is that when a Singapore-listed multinational cannot freely move cash from its subsidiaries back to its main treasury node in Raffles Place, its operational liquidity collapses. Dividends are paid from actual cleared treasury cash, not from paper profits trapped inside a foreign state escrow account. Your yield visibility has gone completely out the window. Evaluating the Singapore Exchange Sector Watch reveals a highly uneven risk landscape across different resource-dependent companies. In the palm oil sector, Bumitama Agri and Golden Agri Resources are placed under a strict caution stance because their yields cluster below our defensive income thresholds. Agribusiness conglomerate Wilmar and industrial infrastructure giant Sembcorp both retain a neutral stance because their global processing footprints and long-term sovereign contract structures fully insulate them from raw export bottlenecks. Our forward-looking scenario matrix highlights a high-probability base case defined by severe bureaucratic bottlenecks, where shipping approvals are delayed by 14 to 30 days, compressing corporate margins. The intermediate pessimistic case introduces international buyer strikes and accelerated capital flight, which would lead to severe earnings compression across all direct Indonesia-exposed equity counters. To protect your personal savings, you must look past corporate public relations and rigorously assess the structural vulnerability of your individual holdings. Before keeping your capital committed, you must ask 3 hard questions of your portfolio. First, what exact percentage of cash reserves held by your agribusiness counters is legally trapped inside Indonesian state banks? Second, how much of your blue chip banking exposure is directly tied to captive coal-fired processing plants on Obi Island? And does the active SGX climate disclosure complaint create an unpriced valuation risk? Third, do your infrastructure holdings contain explicit sovereign protection clauses, or are their cash flows entirely dependent on unregulated merchant commodity volumes? Looking at the forward yields of the palm oil sector, both Bumitama Agri and Golden Agri Resources are currently clustering in the low 3% range. This sits significantly below my 4.7% minimum hurdle rate required for any stock to qualify for a retirement portfolio. Their core production assets are heavily concentrated inside Sumatra and Kalimantan, placing them in a caution stance. The newly imposed state monopoly does not create this underlying yield deficiency, but it completely removes any near-term path to fixing it. For pure-play operators like Geo Energy Resources, this regulatory shift makes a structurally weak income position incredibly dangerous. At a current distribution yield of just 0.9%, Geo sits 230 basis points below my absolute forensic floor of 3.2%. A coal miner paying less than 1 cent of income per dollar invested while operating inside a foreign state-directed export monopoly has absolutely no place in a retirement portfolio. A clean balance sheet cannot compensate for a yield that fails the sanctuary floor. Turning to the commercial banking sector, large institutions like OCBC retain highly resilient balance sheets with interest coverage ratios comfortably above 5 times. However, at a trailing yield of 3.6%, it fails our 4.7% hard gate clearly. When combined with single market concentration risks and the unpriced capital risk stemming from the active February 2026 market forces climate disclosure complaint, the counter is held strictly within a conditional stance for another cycle. If you are currently drawing a salary and building your portfolio through regular contributions, chasing regional commodity yields right now is a completely unnecessary risk. The macroeconomic friction from this foreign state monopoly creates a classic yield trap, where nominal historical distributions are entirely decoupled from future cash reality. Your strategic defensive stance should lean heavily into domestic capital sanctuaries that remain completely insulated from cross-border trade bottlenecks and administrative sovereign approvals. Before we go deeper, if this forensic breakdown is useful to you, the single most useful thing you can do for the channel is hit subscribe. It takes 2 seconds and it tells the algorithm that data-driven SGX analysis deserves to exist. Consider the real scenario of a 60-year-old retail investor living in Marine Parade, who relies on regular distributions from regional agricultural counters to fund daily retirement expenses. If corporate cash flows are delayed by even a single quarter due to automated contract tracking and repatriation mandates, how can that investor fund baseline commitments without being forced to sell down principal capital at a significant loss? The true long-term transformation of this policy lies in the deliberate rewriting of Singapore's historical role as the financial safe haven for regional trade. For decades, our financial system operated on a simple premise. Resources were extracted regionally, but the underlying capital was cleared, held, and managed within the Singapore regulatory enclave. By enforcing a state-directed export monopoly and mandatory domestic bank retention, Jakarta is actively working to dismantle this arrangement and force capital back inside its own borders. You are a forensic investor. You read every single word, you check the corporate gearing ratios twice, and you want the absolute truth before committing a single dollar of your hard-earned capital. But the automated algorithm doesn't know that. It only looks for a single signal to judge the value of independent publishing, whether you have taken 2 seconds to hit that subscribe button. Every forensic investor who reads the data without subscribing remains entirely invisible to the machine. An analyst sitting at a corporate desk in Raffles Place looking out over the container ships anchored in the Singapore Strait can see the physical vessels moving perfectly. But what he cannot see is the legal transformation of the cargo manifest happening inside the record systems of PT Danantara. The physical palm oil is still clearing the regional port, but the steady retirement income that used to flow seamlessly from those voyages into the Singapore clearing system has been caught in a sovereign net. The critical question that you must resolve before the upcoming June corporate reporting deadline is simple. Is your retirement portfolio built on clear cash flows that you actually control, or are you holding paper promises that require the explicit administrative permission of a foreign state to clear? Do not allocate fresh savings to stocks whose earnings visibility depends entirely on the administrative approvals of a foreign sovereign wealth unit. The red flags were always there. If you are managing your own retirement path, relying on historical nominal distributions when the structural rules have been rewritten is how capital gets permanently trapped. If you want the full verified data tables and zero-day access to my comprehensive sector audits before the free versions drop, Iggy's elite investors get full access to real-time monitoring updates, link in the description below. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get zero-day access, link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. Stocks assessed under Iggy's forensic yield standard are benchmarked against the 4.7% minimum yield hurdle. Stocks flagged as growth watch fall below this threshold, but demonstrate clean balance sheet metrics and an identifiable growth catalyst. These carry a materially different risk profile and are not suitable as yield replacements for income-dependent investors. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MATS licensed financial advisor before committing funds. You said, do a check to make sure that there are 26 diagrams for the 26 slides,